Tell me, Mario, why are central banks reducing their holdings of bonds and increasing their holdings of gold, in your opinion?
I think they see what we see, Clive, even though they're central bankers. They're not silly. They know that gold is, I think a lot of them know that what gold is. The other thing I think central banks see, especially the BRICS and Global South central banks, is that they can, the US and the European authorities, they can very easily freeze your reserves of their bonds. They can do that if you do something they don't like. But with gold, they can't. They can't freeze your gold if you buy gold and repatriate it to your vaults, unless they're invaded and the gold's taken from you.
Central banks across the globe are executing a major strategic pivot by reducing their sovereign bond holdings and aggressively purchasing physical gold. Reserve managers are growing acutely cautious about holding paper promises issued by foreign powers. Mario Innecco, a financial commentator, and Clive Thompson, a seasoned market analyst, emphasize that central banks in the Global South and BRICS nations are shielding their reserves from geopolitical risks. When sovereign nations hold foreign bonds, Western authorities can effortlessly freeze those financial assets during political disagreements. In stark contrast, physical gold repatriated to domestic vaults remains completely immune to unilateral confiscation. Looking forward, this sovereign accumulation of physical bullion is predicted to expand and accelerate as central banks continue reallocating capital away from vulnerable foreign debt to ensure complete financial sovereignty. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Are bond markets close to breaking, Mario?
Uh, I've always said that I thought the bull market was over, but like I was warning in 2020, maybe a little early, but yields still bottomed then when they injected massive amounts of QE into the market. But I think there's a danger of the bond market breaking because I think the market, bond fund managers and people who trade bonds and the government, Treasury and the Fed, they seem to be under the impression that we're going to go back to how it used to be from 1981 to 2021, where yields would go down when the economy slowed down and yeah, when we were in this major bull market. But I think now we're in a bear market, and we did, Clive, kind of consolidate since 2023. We didn't go that much higher. So in the U.S. Treasury 10-year yield, I think we went down to zero point 0.3 in 2020. And then in 21 and 22, we broke through, I forgot the exact year, but we broke through 1.5. And here we are at 4.65, I think. And the first time they cut rates, I think they cut rates, Powell, September 2024. He surprised the market by cutting by 50. At the time, the 10-year yield was 3.6. And so why has the curve steepened? Because that's why it's called steepening. Well, because I think the markets realize that the debt is the problem, and I can see you've got a nice chart there of the debt, and it doesn't look good. And this is just a projection from the that
The US
agency,
US government accounting US accountability office.
yeah, which they're usually very yeah, they're usually not right, and things are usually worse than they say. So in this case, I think the debt would get worse, and yeah, so I think they're doing as much as they can. The authorities, like be it the Treasury, be it the Fed, be it the Bank of England, they're doing as much as they can to try to stop these yields going higher. And we are at levels, like you said, almost 20-year highs. I think yesterday they had a 30-year bond auction in the US. And yeah, the 30-year was actually retired for some years in the early 2000s, and he came back. But the last time they had an auction where the yield was 5.22, guess when that was, Clive? 2001.
So some people are going to be saying, well, we've had yields like this before, decades in the past. But the point is, decades in the past, the government debt as a share of the economy, as a share of the GDP, was much, much lower. It was a much lower percentage. Now we're at a much, much higher percentage as a share of the economy. This is what the problem is, isn't it?
Yeah, and in the past, the debt grew as it has, like over 100% GDP during wartime. There was a political reason for it, and people were behind it, like in the U.S., World War II. Well, they weren't behind going to war prior to Pearl Harbor, but that changed everything. And there's a lot we can talk about that, but that's a different topic. But
Well,
the Fed at the time was able to do yield curve control and keep the 10-year, I think, below 2%. And they drove the national debt to over 100% of GDP. But now we haven't, well, I guess we have had wars, but not as big as World War II.
so yeah, historically, governments borrowed money to go and fight wars. But now they borrow money to spend on everything under the sun, including, and I don't want to say this is good or bad, but helping out people who perhaps could be productively employed.
Yeah, that's true. But I think also the fact that they've inflated the system so much and they've kind of lied about inflation through the CPI number. People now are waking up to the fact that they can't afford much, and that's not their fault either. So that's the fault of this fiat currency system we've had since 1971, Clive. I think people, families were a lot better off after World War II to the 1970s. You usually had the husband working, the wife at home. They had he had a good job, and but now everything is the debt and the taxes and, and the inflation. And people think there's no inflation, but there is. You just have to look at gold. Gold going up is actually a barometer of the currency going down. Yeah, so yeah, and we haven't even entered a major war. Hopefully, we won't. And I think they have to keep inflating. Will the central banks be able to step in and do QE and bring rates down? They could, but that would be. I mean, I think the smart money, and like you said, I think in the beginning, other central banks, they're moving into gold, and I think it's going to continue to be the case.
The 4-decade bull market in sovereign debt has ended, giving way to a severe bear market characterized by climbing benchmark yields. Even when central banks cut interest rates, long-term bond yields continue steepening because markets recognize that structural government debt is spiraling out of control. National debt as a percentage of gross domestic product has crossed extreme historic levels, unlike previous decades when economic output easily outweighed borrowing. While authorities once borrowed predominantly to fund wartime efforts, modern deficit spending flows uncontrollably into unchecked peacetime expenditures. Official fiscal reports from government accountability agencies already warn that this trajectory is entirely unsustainable, yet official projections consistently underestimate the true severity of the expanding deficit crisis. Now, let's get back to the interview.
Allow me to read a quote here from the US Government Accounting Office. This is from June the 11th this year, and their quote is as follows: urgent and sustained action is needed to improve the fiscal outlook. And they then go on to say the federal government is on an unsustainable fiscal path that poses serious economic, national security and societal changes if not addressed. Now, the reason I'm reading this is sometimes we have people who say, Clive and Mario, you've been saying the same thing for 3, 4 years, and same old, nothing ever happens. But, it's not us saying it. It's government agencies and international organizations who know what they're talking about are saying it.
Yeah, and I think it was Dick Cheney when he was vice president said that deficits didn't matter or something to that effect. But I think there comes a point where And I'm going to use another like reference from Hemingway. He wrote a novel in which one of the characters was asked, "How did you go bankrupt?" And he said, "Gradually, and then all of a sudden, I went broke." And I think that's what we're seeing, and not just for the U.S., but also for the U.K., Europe as well. Even Germany, their yields are going up, which is unusual. Japan, I think, is a big case as well, even though the Japanese, they own most of their debt domestically, and I think the BOJ owns 50% of it. But I think, Clive, it will be reflected in massive debasement of the currencies, and that's why I tell people, if possible, to have some gold and silver to protect your savings, because if you leave things in fiat currency and in bonds, you're going to be wiped out.
Tell me, Mario, why are central banks reducing their holdings of bonds and increasing their holdings of gold, in your opinion?
I think they see what we see, Clive, even though they're central bankers. They're not silly. And they know that gold is, I think a lot of them know that what gold is. The other thing I think central banks see, especially the BRICS and Global South central banks, is that they can, like the US and the European authorities, they can very easily freeze your reserves of their bonds. They can do that if you do something they don't like. But with gold, they can't. They can't freeze your gold if you buy gold and repatriate it to your vaults, unless they're invaded and the gold's taken from you, like the Germans did in 1939 when they invaded Prague. They went in there, and first thing they did, Clive, when they invaded all these countries, was go to the central bank.
Are they going to redirect this newfound wealth into what will they redirect their newfound wealth into?
Oh, you mean the people, the 1% or top 10?
Yes, exactly.
The one
The
that, the
government
ones
gets
that,
poorer, so someone's
yeah,
getting richer.
yeah, the ones that have most of the assets. I think 10% of the richest Americans, they own like something like 80% of all the wealth. Well, they're going to go into hard assets, Clive. Also gold and silver, natural resources, land, antiques, even, fine wine, everything that is valuable. Companies as well, even in the stock market, companies that produce real things, even companies that are in tech, I would say. But I don't think they're going to be going into the banking sector or insurance and yeah, places like that, because banks as well, Clive, they hold a lot of these government bonds as part of their balance sheet.
Decades of fiat currency expansion since 1971 have severely eroded real purchasing power, masked only by misleading official inflation metrics. National balance sheets across the United States, Europe, and Japan are deteriorating, demonstrating that sovereign insolvency arrives gradually and then all at once. As governments exhaust their fiscal headroom, smart capital belonging to the wealthiest asset holders is systematically abandoning institutional paper claims. Traditional commercial banks and insurance companies carry heavy balance sheet risk due to massive portfolios of depreciating sovereign debt. Consequently, private capital is rotating directly away from the financial sector and moving aggressively into tangible, hard assets. Wealth allocators are securing physical silver, productive agricultural land, raw materials, rare collectibles, and fine wine. Equity investments are simultaneously focusing on cash-flowing technology innovators and productive companies that manufacture essential physical goods rather than leveraged banking vehicles. Holding unbacked currency and long-duration paper leaves capital exposed to severe debasement, making scarce physical assets the primary foundation for long-term wealth preservation. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.